Hey, welcome back to the channel. This is Fredpasselli.cpa based out of South Florida. So in our last video, we discussed deferred expenses and deferred revenues. Just to reiterate what those are, is that is when you are going to defer the recognition of revenue or defer the recognition of an expense due to not incurring it yet. So today, what we're going to talk about are the other adjusting journal entries, which are going to be accrued revenue and accrued expenses. So these actually operate the exact opposite way of deferred revenue and deferred expenses. Accrued revenue and accrued expenses is when you actually are going to recognize the revenue or recognize the expense / incur the expense before you're actually receiving payment or before you're dispersing payment in the case of an expense. So examples that I like to give of this are, let's say you are a consulting company or a service business or even just a brick and mortar retail store. You are going to sell a product, sell a service, perform a job, finish the performance obligation. You are going to then record revenue because you have sold the item or finish the job. But in this case, in an accrued revenue, you're not getting paid yet. That means your customer has not paid you. They put it on account or some form of credit. So this is what's going to give rise to accounts receivable. So normally this is when you don't get paid right away and you plan on getting paid in the future. So an example of this would be, let's say you are a contractor, you go out and complete an entire job, and then you invoice your customer. Your customer is going to pay now in 30 days. So during that 30-day window, you're going to have an accounts receivable for that customer. So the initial journal entry to recognize the revenue would look like something like this. You would debit accounts receivable, which is an asset account, and you would credit revenue or service revenue for the amount of the job that you completed. So let's say it cost $30,000 to complete a pool project. So you would debit accounts receivable for that specific customer, $30,000, and then you would credit service revenue for $30,000. So that's the first step of the overall accrued revenue. Then let's get to the adjusting journal entry part. Let's say 2 weeks go by, 3 weeks go by, and now you're going to collect on the outstanding receivables, meaning the customer has now paid you. They no longer owe you the $20,000. So in this case, you're going to remove the receivables, you're going to net it to zero, and you're also going to collect or debit cash because you're receiving cash now. You need to increase the cash account. So what you're going to do is you're going to debit cash for $20,000, and then you are going to credit accounts receivable, the former asset used in the first entry, to remove the receivable balance associated with that customer. What's going on now is they don't owe you money anymore, so you're removing their receivable balance, but you're recording the cash you received from them. So there's no net change in the asset balance, but you now have the cash. So in the first entry, we recognize revenue before receiving the actual cash. That gives rise to the accounts receivable. And then in the second entry, we're now receiving the cash. So we're writing off the initial accounts receivable, and essentially cash has been now received and the revenue has been recognized. So the full entries from start to finish with accrued revenue: the initial entry, debit accounts receivable, credit service revenue for the amount of the service performed or the amount of goods sold. Then when you collect on that cash related to the revenue, you're going to debit cash for the amount received and credit accounts receivable for the amount received or the amount you're writing off. Okay, so that's an accrued revenue. Now accrued expense is going to work in a similar manner, but it's going to be on the flip side. It's when you haven't paid someone yet. It's when you owe someone money. So in this case, let's say you are purchasing an item from a vendor. They send you an invoice. Let's say you purchased $30,000 worth of office supplies. They send you an invoice, you receive the items, so you incurred the expense. You've received the benefit already, you have the items on hand. So you're going to now debit, let's call it office expense, $30,000. And you're going to credit an account called accounts payable. Accounts payable essentially means you owe them. You haven't paid them yet, so you're accruing the revenue. You're going to pay them in the future, but you have not just paid them yet. Based off the invoice, you have 30 days. Sometimes you like to pay a little sooner. Tend to not pay after the 30 days. So you're going to debit office expense, $30,000, credit accounts payable for $30,000. So remember, accounts receivable, that's associated with revenue. Accounts payable will be associated with expenses. That's very important to understand because a lot of students tend to get confused between the two and they don't differentiate, and it will cause your journal entry to be wrong. Okay, so now we incurred the expense, we received the expense, we debited office expense $30,000, credited accounts payable $30,000. Now let's say 3 weeks go by. We are now going to pay the vendor, disperse cash to them. So we send an ACH, $30,000. We are now going to debit accounts payable for $30,000 because remember, we're removing that accounts payable because we no longer owe them. It originally had a $30,000 credit balance. To remove it, we have to debit it for $30,000. So we're debiting accounts payable for $30,000, and then we're going to credit cash for $30,000 because we're dispersing the cash account. We're paying in cash. So then that is going to record the payment of cash, then that adjusting journal entry is done. So remember, deferred expenses, accrued revenue, accrued expenses, they're both going to be when you recognize the revenue, but you have not received payment. That gives rise to accounts receivable, or when you recognize or incur the expense, but you have not paid the vendor yet. That gives rise to accounts payable. And then simply when you do pay or you do receive payment, you would remove the associated or reverse the associated accounts receivable or accounts payable, and then either debit or credit cash depending on if it's an accrued revenue or accrued expense. So far we've covered accrued revenue, accrued expense, deferred revenue, deferred expense. These are all the main adjusting journal entries. In the next video, I'm going to cover closing out temporary accounts to permanent accounts. This is another topic that Accounting 1 students tend to struggle with, and it's very important to learn this because it helps flow all the profit and loss statement to the balance sheet, to the retained earnings, to the cash flow. All right, thank you for tuning in again. If you have any questions, don't hesitate to reach out to the contact information below.